Most investors won't lose money in the next crisis because they picked the wrong asset. They'll lose it because they picked the right one at the wrong time. Gold, silver, cash, bonds, almost everything people call safe behaves very differently once panic actually starts. And if you don't understand the sequence, not the asset, you're going to do exactly what everyone else does. Sell what protects you and hold what hurts you. By the end of this video, that mistake will be impossible to make again. Right now, as economic storm clouds gather, everyone's debating gold versus silver like it's a simple choice between two similar assets. But here's what the data from every major crisis reveals. These metals don't just perform differently, they operate in completely different phases of financial chaos. Understanding this timing difference isn't just important, it's the difference between preserving your wealth and watching it evaporate. Today, I'm going to walk you through exactly what happened to gold and silver during the three most devastating financial crises of the past 25 years. Not the sanitized versions you hear in investment seminars, but the raw, uncomfortable truth about how these metals actually behave when the world is falling apart. Then I'll show you why the coming crisis will amplify these differences in ways most people aren't prepared for. Let's start with a crisis that feels almost quaint by today's standards, the dotcom crash of 2000. Picture this. It's March 2000, and the world has convinced itself that technology has rewritten the fundamental rules of investing. Valuations are irrelevant. Profits are optional. Growth stories alone can justify any price. Then reality hits, and one of the most brutal market corrections in modern history begins. When that crisis started, gold was trading around $294 per ounce. Gold wasn't popular. It wasn't exciting. It was basically ignored while everyone chased internet stocks. But as equity markets started their spectacular collapse, something fascinating happened with gold. It didn't rocket higher like you might expect. Instead, it drifted lower over the next 11 months, eventually bottoming out near $254 per ounce in February 2001. That's about a 14% decline from where it started. This is where most people completely misunderstand gold's role. They look at that decline and say, "See, gold didn't protect anyone." But they're missing the crucial context. While gold was down 14%, the Nasdaq was imploding by more than 50%. And it would continue bleeding for another year and a half. More importantly, gold's decline stopped. From that February 2001 low, gold began a slow but steady recovery. It took about 350 days for gold to climb back to its pre-crisis level, and while the broader economy was still struggling, gold kept moving higher. By mid-2002, gold had reached around $331 per ounce, finishing the crisis about 12% higher than where it began. Now, let's look at silver during the same period, because this is where the story gets interesting. Silver started the dot-com crash at around $5.26 per ounce. As the crisis unfolded, silver didn't just drift lower like gold did. It fell harder and stayed down longer, eventually reaching a low near $4.04 in late 2001. That's more than a 23% decline. Here's the critical detail that changes everything. During the entire crisis window, silver never recovered to its starting level. Not once. Investors who bought silver expecting it to act as a safe haven had to wait years, not months, just to break even. This gives us our first clear pattern. In a relatively straightforward crisis, driven mainly by speculative excess in one sector, gold limited its losses, recovered within the crisis timeframe, and ended higher. Silver suffered deeper losses and failed to recover when it mattered most. But the dot-com crash was child's play compared to what came next. Fast forward to 2008, and we're facing something entirely different. The global financial crisis wasn't a sector problem or a speculation bubble. It was a systemic failure of leverage, trust, and credit that brought the entire global financial system to its knees. When Lehman Brothers collapsed, markets didn't just decline, they froze. At the start of this crisis, in December 2007, gold was trading around $843 per ounce. Confidence was already shaking, but full-blown panic hadn't arrived yet. Then panic did arrive, and it was brutal. Over the next 10 months, as major banks failed and credit markets seized up completely, gold fell sharply. By October 2008, gold had dropped to around $681 per ounce, a decline of about 19%. This is the moment where most investors lose their discipline entirely. While gold was down 19%, equity markets were collapsing by 40, 50, even 60%. Real estate was freezing. Credit markets were completely broken. And yet, people looked at gold's performance and concluded it wasn't working. But here's what actually happened next, and this is crucial. From that October 2008 low, gold recovered with shocking speed. In just about 50 days, less than 2 months, gold climbed back above its pre-crisis level of $843, not after the economy recovered, not after banks were healthy again. While the crisis was still raging, gold didn't stop there either. By March 2008, even before the worst of the crisis had passed, gold reached a high above $1,030 per ounce. That meant gold gained over 22% from its starting level, while the crisis was still destroying everything else. Silver's path through the 2008 crisis tells a much harsher story. Silver entered the crisis trading around $14.90 per ounce. As liquidity vanished from markets, silver didn't just fall, it collapsed. By late October 2008, silver had crashed to near $8.40 per ounce. That's a drawdown of more than 43%. Think about the mathematics of that loss for a moment. To recover from a 43% decline, you don't need a 43% gain. You need almost 76% just to get back to break even. That's the brutal arithmetic most people ignore when they're chasing what they think are bargains. Silver did eventually recover, but it took around 7 months, roughly 210 days from the bottom, just to return to its starting level. Many investors never stayed long enough to see that recovery, let alone the eventual gains that came later. Meanwhile, gold investors were already above water and had liquidity available while others were still trapped in losing positions. Now let's examine the most recent crisis, because this is the one most people experienced emotionally rather than just intellectually. In February 2020, just before the world shut down, gold was trading around $1,689 per ounce. Then in March, everything broke at once in ways nobody had ever seen before. Stocks crashed, bonds sold off, commodities collapsed. Even gold fell initially, dropping to around $1,451 per ounce within weeks, roughly a 14% decline. But then something remarkable happened that demonstrates gold's true power during genuine crises. By mid-April, just 28 days after hitting its low, gold had already recovered to its pre-crisis level, less than a month. And while the global economy was still shutting down and uncertainty was everywhere, gold continued rising, eventually reaching a high above $2,075 per ounce by August 2020. That's almost a 23% gain from the start of the crisis, achieved while massive uncertainty still dominated every market. Silver followed its now familiar pattern of suffering first and recovering later. Silver started the COVID crisis at around $18.95 per ounce. When panic hit in March, silver collapsed violently, falling to about $11.60, nearly a 39% decline in a matter of days. Silver eventually recovered, but it took roughly 4 months before it returned to its starting level. And yes, silver then surged dramatically to almost $30 per ounce, delivering more than 57% gains from the crisis start. This is where most people stop thinking clearly. They look at those final numbers and conclude that silver performed better. On paper, over a very specific time window, that's mathematically correct. But markets aren't experienced on paper. They're experienced in real time, under stress, with genuine uncertainty about the future. This brings us to the core lesson that changes everything about how you should think about these metals. Gold consistently enters crises at elevated levels, falls moderately during the initial panic, reaches its bottom relatively quickly, recovers to its starting level faster than almost any other asset, and often makes new highs while the crisis is still unfolding. Silver consistently enters crises at elevated levels, falls much deeper, takes far longer to recover, and only generates those outsized returns after surviving brutal drawdowns that destroy most investors' ability to hold on. This isn't about which metal is inherently better. It's about understanding their distinct roles in the sequence in which they operate. Gold functions as a first-phase asset. It protects capital when fear is highest. It preserves liquidity when others are forced to sell. It allows you to wait and maintain optionality. Silver operates as a second-phase asset. It can generate powerful returns, but only if you enter after the initial destruction, or if you have both the emotional and financial strength to survive massive drawdowns. This is why professional crisis strategies don't start with silver. They start with gold. Gold's greatest value isn't just that it appreciates during crises, it's that it declines less, recovers faster, and gives you options. Optionality is the most underrated asset during any crisis, because once panic forces others to sell quality assets at steep discounts, the investor holding gold isn't reacting emotionally. They're making calculated choices. They can rotate into bargains. They can speculate on oversold assets. They can buy fear when others are selling it. Silver can absolutely be part of that second phase strategy, but only for investors who truly understand the risk, the timing requirements, and the psychological costs involved. Let me pause here for a second. If the crisis started tomorrow, would you feel comfortable watching an asset drop 30, 40% knowing it might outperform later? Or would that push you out at the worst moment? Drop a comment. Your answer matters more than you think. Now, moving forward. When someone tells you that gold is just protection while silver is where the real money gets made, understand what they're really saying. They're encouraging you to skip the hardest part of crisis investing, survival itself. Crises don't reward bravado or wishful thinking. They reward structure and discipline. When you examine gold and silver through actual data, precise timing, and real behavioral patterns rather than marketing slogans, the picture becomes crystal clear. Gold protects first and performs consistently. Silver destroys wealth first and only rewards those who survive long enough to see the recovery. Understanding that fundamental sequence is the difference between surviving a financial crisis and becoming another casualty of it. But here's what makes the coming crisis different and potentially more dangerous for precious metals investors than anything we've seen before. The next financial crisis won't be a repeat of 2000, 2008, or 2020. It will borrow elements from all of them, but the underlying structure is fundamentally different in ways that matter enormously for how gold and silver will behave. Let's start with silver, because this is where expectations need the most dramatic adjustment. Silver today is far more exposed to industrial demand than it was during previous crisis cycles. A significant portion of current silver consumption is tied directly to electronics manufacturing, semiconductor production, solar panel construction, data center expansion, and advanced manufacturing processes. In other words, silver is now deeply embedded in the same industrial and technological ecosystem that has been driving much of the speculative excess we've witnessed over the past few years. This matters because the coming crisis is likely to hit that ecosystem at its core for the first time in modern history. We're facing the risk of a synchronized slowdown across technology investment, industrial expansion, and credit availability all happening at once. If the artificial intelligence investment cycle slows down or reverses, if capital spending contracts sharply, and if companies are forced to cut budgets instead of expanding them, industrial demand for silver doesn't just soften gradually. It can drop off a cliff. This isn't theoretical speculation. Industrial commodities are extremely sensitive to future expectations, not just current demand. When companies stop planning new factories, new chip production facilities, new infrastructure projects, the demand for industrial inputs collapses faster than most people expect. And silver, unlike gold, cannot escape that dynamic because of its heavy industrial component. In previous crises, silver suffered large drawdowns primarily because of uncertainty and speculative unwinding. In the coming crisis, that uncertainty could be amplified significantly because a large portion of today's silver demand is concentrated in high growth, high expectation sectors that are particularly vulnerable to a repricing of risk, especially if the artificial intelligence narrative begins to crack. If the AI investment bubble begins to deflate even partially, the effect won't be gradual. It will be abrupt. Projects get paused immediately, orders get delayed or canceled, inventories get liquidated, and silver prices, which already carry substantial speculative positioning, tend to react violently to that kind of shift in sentiment. This is why it's reasonable to expect silver to experience a more aggressive initial decline than we saw in previous crises, not because silver itself has fundamentally changed, but because the industrial side of its demand profile is now more cyclical, more concentrated, and more exposed to the very sectors that face the highest risk. At the same time, silver remains a relatively small and volatile market compared to other commodities. When fear rises and risk appetite disappears, liquidity in silver can dry up very quickly. That combination of falling demand expectations and shrinking liquidity creates perfect conditions for outsized drawdowns that can trap investors for extended periods. This doesn't mean silver is permanently impaired or that it won't eventually recover. It means silver is likely to suffer first and hardest, well before it becomes an interesting investment opportunity again. Now contrast this challenging outlook for silver with gold's position heading into the next crisis. Gold enters this crisis from a completely different structural position than it occupied in previous cycles. Gold today is not primarily an industrial asset subject to economic cycles. It functions as a monetary asset in a world where trust in monetary systems is quietly but steadily eroding. Central banks globally are accumulating gold reserves, not because they expect economic growth, but because they're preparing for potential instability. Large institutional investors are increasing their gold exposure, not because they expect quick profits, but because they're hedging systemic risks that have no other adequate hedge. More importantly, there's an additional force at play now that didn't exist to the same extent during previous crises. In past financial crises, gold had to compete with other perceived safe haven assets. Government bonds were widely trusted. Cash was considered safe. Even real estate was viewed as defensive. Today, many of those traditional alternatives are structurally weaker than they've been in decades. High and rising sovereign debt levels, growing concerns about long-term fiscal sustainability, and increasing policy unpredictability have changed how sophisticated investors perceive government bonds. Persistent inflation has altered how investors view cash as a store of value. Stress in commercial real estate has changed perceptions about property. Even equity sectors, traditionally considered defensive, face liquidity risks in a systemic downturn. As a result, when assets get liquidated out of fear rather than optimism, the pool of credible places for that capital to flee becomes much smaller than in previous crises. And when investment options shrink, concentration into the remaining alternatives increases. This is where gold's role becomes potentially more powerful than in previous crises. Gold is increasingly becoming the last truly neutral asset. It's not a promise from any institution. It's not someone else's liability. It doesn't depend on corporate earnings, policy decisions, or industrial demand cycles. It simply exists as a store of value that has survived every monetary system in history. In the coming crisis, as investors reduce exposure to risk assets, sell equities, question bond values, and pull back from leveraged positions, a significant portion of that capital needs somewhere to go, not to speculate or generate returns, but simply to wait safely. Gold is uniquely positioned to absorb a substantial portion of that defensive capital flow. This is why expectations for gold performance in the next crisis are structurally different from previous cycles. Not because gold itself has changed, but because the competitive landscape for defensive assets has deteriorated significantly. In 2008, gold competed with government bonds that were still widely trusted. In 2020, gold competed with cash during what appeared to be temporary economic shutdowns. Today, gold competes with far fewer credible alternatives for defensive capital. That structural change has important implications for the magnitude of gold's potential move. While gold may still experience a temporary pullback during the initial panic phase, driven by the same forced liquidation dynamics we've seen before, the scale of that pullback is likely to remain limited relative to other asset classes. And once the forced selling phase passes, the recovery dynamic could be both faster and more aggressive than in previous crises. This won't happen because investors suddenly become optimistic about the future. It will happen because they become more defensive and realize their options are limited. In that environment, gold transitions from being just a crisis hedge to becoming a default holding for capital that has nowhere else safe to go. This creates an important secondary effect that amplifies gold's advantage. As gold appreciates and stabilizes during the crisis, it provides both liquidity and confidence to investors holding it. That liquidity can then be strategically redeployed into discounted equities, distressed assets, and yes, eventually into silver once it has completed its brutal washout phase. This is the sequence that will matter most in the coming crisis. Silver may become extremely attractive later in the cycle once industrial demand stabilizes, once the speculative excess has been completely washed out, and once the worst of the credit stress has passed. At that point, silver's inherent leverage characteristics work in your favor rather than against you. But entering silver too early, before that washout process completes, exposes you to the full destructive force of the downturn with very little downside protection. Gold, by contrast, is positioned to benefit directly from fear itself and the flight to safety that fear creates. So when we project forward into the next crisis, the expectation shouldn't be that gold and silver will simply repeat the same percentage moves we saw in past crises. The expectation should be that their performance divergence will become more pronounced than ever before. Silver is likely to fall harder in the early phases, reflecting both industrial demand contraction and speculative position unwinding. Gold is likely to recover faster and rise more decisively as capital migrates away from assets perceived as fragile or risky. This doesn't make one metal fundamentally superior to the other. It makes timing and role assignment more critical than they have ever been. In this crisis, more than in any previous modern crisis, gold is likely to serve as the anchor that prevents your portfolio from drifting into dangerous waters. Silver is likely to serve as the amplifier that can generate substantial returns, but only after the initial storm has passed. Understanding that crucial distinction ahead of time is what allows you to navigate the coming environment proactively, instead of simply reacting to events as they unfold. The investors who recognize this sequence and position accordingly will have the opportunity to not just survive the coming crisis, but to profit from the fear and mistakes of those who don't understand how these metals actually behave when the world is falling apart. As we move forward into increasingly uncertain times, remember that successful crisis investing isn't about predicting exact outcomes or timing perfect market tops and bottoms. It's about understanding the structural roles different assets play during periods of genuine financial stress. Gold provides the foundation. Silver provides the leverage, but only if you get the sequence right. The crisis is coming whether we want it or not. The question isn't whether you'll be affected. The question is whether you'll be prepared. This is just one piece of the bigger picture. Subscribe if you want to understand the full context and how to better protect yourself in uncertain times. And the video on screen takes this story one step further.